The accounting cycle represents a 6-step process that culminates with the creation of financial statements and with the analysis of financial statements. And we as external stakeholders, of course, utilize that information for the purpose of making decisions, whether it be to invest if you were an investor, or to potentially do business with an organization if you were a supplier, or potentially evaluate it for accuracy if you were a government agency like the SEC, for example. Now, as internal stakeholders, like managers and department heads and those types, they of course utilize financial information for the purpose of making decisions about potentially whether to hire staff or whether to change production schedules and those types of things. So this accounting cycle, although it culminates with the creation of financial statements, it really highlights the steps that are needed to get to the place to where we have those financial statements. And although we commonly see the financial statements and we interact with that portion or that step of the cycle, there are a number of different things that have to happen in order to be able to produce those statements. So my hope would be with this video is that you would get a general overview of the steps involved in accounting and the key steps involved with accounting that ultimately produce the types of financial statements that we see on a regular basis. So to start us off, we're going to start with the very first stage here, and that is going to be where we analyze what we call source documents. And source documents include the sources of information. So what you're talking about is many organizations produce a number of different financial transactions, whether that would be sales or that would be expenses. So purchasing office supplies, paying salaries, bringing in revenue from a number of different products. Each of those represents a source document. And so what has to happen first in the accounting cycle is bookkeepers commonly have to go through all of the different transactions and they have to classify those particular transactions. And so they're taking all of these different sales receipts and purchasing receipts and shipping documents, and then they're organizing them in such a way that we're going to be able to produce financial statements. So that's the very, very first step that has to take place in the accounting cycle. Now, the second step to this process involves recording transactions in journals. And these journals can be actually physical journals, and you've probably seen these before if you've done any kind of bookkeeping where you're actually physically writing out the transactions that are taking place, and you have journals for different categories of transactions. Nowadays, with the kind of evolution of technology and the ubiquity of software, we utilize a number of different accounting types of software, including QuickBooks, which is very common, to Aplos and to others. And those are meant to really record the actual transactions that take place. This is where they're first entered into these different journals. So this is really one of the first steps beyond just categorizing them and figure out which kind of entries they are, obviously recording them so that they're written down. And then, of course, we can organize them moving forward. Now, the third step to the process involves transferring the journal entries to what we call a ledger. And this is commonly done with computer programming and software as well. But this ledger here, I'm going to describe this briefly, is really kind of a specialized accounting book or program. And the whole idea here is they accumulate specific categories. So you have specific categories that are posted. And what they do is they accumulate those pieces of information so we can look at the ledger for specific types of expenses or for revenues. And so that managers here, the idea is that you can find all the information about one type of account in the same place. So with journals, we're really just notating each of the transactions. With a ledger, it is very specific to the category that's taking place. And so it allows managers to obtain all of that information. It's all in one place. And then we can see the types of transactions that have happened within a certain area. Now, after taking the transfer to the ledger, the next step of the process, which is step 4, is then producing what we call a trial balance. And a trial balance is really what we call a summary of financial data. And it really summarizes what's in the ledgers. And the idea here is that it would allow accountants the opportunity to identify the issues that are going to take place and then, of course, correct them before we move on to step 5. Now, the 5th step in this process is going to be to produce financial statements, or let's say prepare financial statements. And this is rather self-explanatory. If you're utilizing some kind of software, assuming that you're kind of going back in this process, so kind of going through step one, assuming that we've kind of taken a look at all of the source documents and categorized them effectively, and assuming that we've recorded them accurately, and then of course being transferred into the ledger and looking just as kind of a quality assurance mechanism in the trial balance, preparing financial statements should be rather simple, especially with today's technology. It really is a matter of a few mouse clicks to produce financial statements, assuming, of course, that they've all been categorized and organized in a fairly effective manner. And that takes us to the last step in the process, which, of course, involves analyzing those financial statements. And this is primarily done by accountants who, again, are going to be looking at those statements and trying to identify some kind of trends and then reporting those potentially to the managers within the organization. Now, if you were to look at these steps of the process, you would notice that there really is a division of responsibility here. So when you talk about analyzing source documents and even all the way up to transferring to the ledger, you're really looking at the responsibility generally of bookkeepers to handle that step of the process. And when it gets to taking a look at the trial balance, preparing the statements, and analyzing those, then you're looking at the role of accountants in this process. And so it really is kind of a shared role between those two individuals to really help produce accurate financial statements.